Hello and welcome to our third quarter capital markets recap. I'm Dave Brinkman and I'm joined by our Chief Investment Officer, Jason Staley. Jason, the opening sentence to the quarterly letter this quarter is the most infamous words in finance are, "This time is different." Would you care to elaborate?
Yeah, I think they're sort of the most infamous words because normally when you utter them to justify an anomaly, something that's deviating from historical fact patterns, it typically and almost always does come back to ring true.
No, it was not any different.
It just was
right?
not any different.
Yeah.
I think during the pandemic we heard the phrase uttered, this time is different because we had gone through something like this, and then the unprecedented amount of monetary stimulus by central banks, and then the fiscal response from global legislatures to justify rescuing this economy that we put into a coma. They kept saying this time is different. It won't end. It won't end with higher inflation. We'll be able to have the soft landing. And when you look back at the last 9 months and certainly what happened in the third quarter, I think it's fair to say that this time wasn't different. And what we're seeing in the last 9 months and certainly the last 3 months that we're recapping here is that it's not only was this time not different, there's a backlash to that thinking, right? We are unwinding everything that we did in 2020 and 2021. And I think it's really important for us to acknowledge that. And I think part of the frustration among some market participants is that global central bankers still have not made that mea culpa that many people think that they need to make.
Jason, what I heard you just say was, the money supply or the stimulus, right? And to be fair to officials in the early part of 2020, right, specifically March and April, we had no idea globally what was or wasn't about to occur. So you're talking about the money supply and the stimulus, and whether you call it the great re-rate right now with interest rates going up, we're going to touch on that in a second, or in simple terms, is it fair to say, look, we're just unwinding the liquidity that was dumped into markets over the last 2 years?
Yeah, and I think that it's certainly fair to say that in the early days, weeks of the pandemic, there were some prudent cautionary measures that were taking place. But what ended up happening, and this is what happens when you have kind of mission creep, if you will, is that it ended up being the global central bankers and fiscal bodies, legislative bodies across the world tried to make everybody a winner. It certainly felt like that in the U.S. Everybody was winning. Whether everybody had a friend, colleague that was killing it day trading, right? Stocks, crypto, they're making all this money. And certainly balance sheets were never more flush. Personal, business, housing prices were going up. If you could buy a car in 2020, you were paying well over the sticker price for it. It would be, hey, the MSRP is $50,000. We'll sell it to you for $62,000. And people were doing it because the supply and demand was so far out of whack, right? Because we put so much stimulus and everybody was winning. And it was great, right up until the point that it wasn't. And I think that's the one thing that we are learning the hard way in the US is that not everybody can be a winner. Capitalism is this messy system, but it's efficient. Over a longer period of time, it's very efficient in terms of weeding out winners and losers, right? And what a recession is that companies that have made really good decisions, both from a human capital standpoint, from acquisitions or prudent management of their balance sheet, they survive. And companies that have made poor decisions, poor investment decisions, poor capital allocation decisions, they unfortunately go through a cleansing where they have to restructure or they go out of business. And I'm not saying that bankruptcy, companies going bankrupt is a good thing, but it's a necessary thing in a capitalistic society because not everybody can be a winner. Because when you try to make everybody a winner, what you see right now is the end result of it, which is 8.5% inflation, home prices decreasing. You've got the 30-year mortgage at almost 7%. And I think that's what's happening. You called it the great re-rating, and that's what's happening is that all this stimulus is starting to burn off. All the liquidity that was poured into the system that made everybody a winner is now kind of coming back, and we have to pay for that.
I think the frustrating thing for you, the clients, the audience, and look, we live this every day. All this is obvious in hindsight.
Right.
It's never obvious in the moment. I mean, what you just described to me was, look, business cycles aren't dead. There's booms and busts, generally speaking, over a 5 to 10 year period, maybe a little bit longer in this instance. But business cycles aren't dead. Human emotion's not dead. And that's what makes all of this so hard. I mean, Jason and I can sit here and armchair quarterback this all day long. And it's all obvious now that what we were doing in 20 and 21 was going to result in ignite the inflation inferno, if you will. But in the moment, it's never that obvious.
No, it's not that obvious. But I think that there were, certainly, signs where you have stocks trading at elevated valuations.
Yeah.
And the idea that you could keep interest rates anchored at zero forever while continuing to print money. This was an experiment that was never before contemplated, right? I mean, I don't even know that some of the things that were done were even put up on a chalkboard before they were put into the global ecosystem.
Yep. All right, so Jason, we just talked about money supply, hinted at inflation. Let's go there, right? And interest rates have moved at an incredibly fast pace, and I'm just looking at the end of last year to now. What is spurring that, right? I mean, big picture and trying not to go too deep on Finance 101, what we, globally speaking, we are trying to dampen down demand.
Correct.
To try and get back to some sort of equilibrium or edge back. And it doesn't have to just be on interest rates. It could be the labor market. It could be a litany of markets that arguably have gotten themselves out of whack. So maybe for the audience, let's talk interest rates, let's talk demand, supply, and any other observations.
And I think you have to go back, and those are great points and a nice segue. You have to go back and understand, well, how did the supply and demand curves get so out of whack? And we can just start with what we did domestically here in the US, because we had probably the largest policy response. But this was in some way, shape, or form done across all the developed and emerging economies. So I think that the size and scale of it, if you just take what we did in the US and then apply it, you're gonna get to see the picture. But we did a $350 billion PPP program, right? That essentially incentivized employers to keep employees. Okay, seems reasonable enough.
Sure.
This was done in March.
Well intended.
We'll debate the fraud and all that kind of stuff that goes along with the government intervention at a later date. But $350 billion to incentivize employers not to let go of employees. Okay, so that should in theory stabilize income streams, right?
Sure.
Well, then on top of it, Congress, through two administrations, right? Through the Trump administration, we had 2 stimulus payments, and then President Biden's administration came in and did a 3rd stimulus payment in 2021. You had something like 472 million stimulus transfers, individual transfers, totaling some $803 billion. Okay, so you've got 350 billion in PPP, another 800 billion in individual stimulus payments over the course of less than, call it 18 months.
Yep.
And then that was just the fiscal response. The monetary response, we took interest rates to zero. The Federal Reserve went and bought everything from high yield bonds to U.S. Treasuries, mortgage-backed securities.
Right.
And you pumped all this liquidity in. And what did consumers do? Well, they went out and spent. So we put the global economy into a recession, into a coma. All the while, we juiced balance sheets where the balance sheets were the healthiest they've ever been.
Right.
You've never had that in a recession where incomes went up. Like, that doesn't happen, but it did.
Right.
And so consumers did what consumers will do when their balance sheets are flush. They went out and spent iPhones, phones, computers, iPads, and then they moved houses. And then they moved from that. They moved from like durable goods to, once the economy went back up, or reopened back up in 2021 post the vaccines, they went out and they spent everything on the service side. Go to an airport, tell me there was a recession. Go to a hotel, go to a restaurant. So then we just moved all of the demand from durable goods to consumers. All the while, we're spending all of this money constraining supply chains, right? We got to produce these durable goods. We got to produce the cars. Got to build new houses, which has been an incredibly frustrating endeavor. All of this kind of led to demand far outstripping supply, and you end up, when that happens, when you keep spending and you keep you keep trying to buy things, the natural market response is for the price of those goods to go up, the prices of those services to go up. And now you'll find when you go into like an airport, you go to buy a Starbucks, there's a retention, an employee retention service fee because of how much it costs to retain and go attract labor. And that's where, again, when you talk about kind of weakening demand, what central bankers are now saying is that the economy is too good. We've overheated it, right? You have full employment, and you still have inflation running at 8.5%. So for us, it is very difficult to watch this unwind because there's no easy answers.
Well, there's nowhere to hide unless you're sitting in cash. And over the long run, I mean, we've had conversations about that. In the long run, that's not a winning strategy.
We were told by the evangelists here that, in the market that, we were going to be able to do the soft landing, that all this wasn't going to cause inflation, that it was going to be transitory.
I was curious if you were going to hit on transitory.
That's
you
all we heard.
That. Yes.
They would mention transitory like 10 times. 10 times a minute when one of the Fed speakers would go on CNBC or Bloomberg. And they went from, hey, inflation is going to be transitory all of 2021 to, oh, we got to be, now we have to be these policy hawks.
Yep.
And we got to crank interest rates, from essentially 0 to 4%, where we are on the 10-year Treasury yield right now in the course of 9 months. And I make the remark in one of the footnotes that the change in posture by the Federal Reserve, I mean, that would even make the most opportunistic politician blush in terms of the change in posture. I mean, it's one of those things where it's truly remarkable that they went from, interest rates, we were going to have maybe one interest rate hike in 2022 to we've had back-to-back 3/4 of a basis point or, 0.75 basis point increases the last 2 meetings. And a third one looming.
The part that the stat I've been watching that I just find really interesting, right? So right now, if you believe the government's data, there's 10 million jobs open, right? They're looking for candidates, and there's about 5.5, 6 million people unemployed. So rough back of the envelope math, there's roughly 2 jobs for every person that's unemployed. But what I've seen play out between the August and September numbers, there were 1 million jobs that came off the market in a month. So you're starting to see things, it's by no means equilibrium. And I don't know that things are ever perfectly equal. That's just, unfortunately, life never lends itself to that. But I do think you are starting to see some of these things. And look, these things will play out in the next 6 to 12 months to the extent that we're trying to cool demand. You're going to start seeing it because financing is no longer zero.
No, and I think you're starting to see the labor market beginning to show signs of cooling off. And policy always has a lag, right? It's a 6 to 9 month lag. So they raise interest rates, and you don't automatically see the banks passing that through, right? The yield on your savings account isn't getting any better. So
I think I heard this stat today. So if rates go up 1%, the banks through the money market yields might pass through 0.1% of that.
That's
right, 10% of it.
It sounds about right.
Yeah.
But you're starting to see the defects of people are pulling jobs off the market, right? They're going to do more with less. You're starting to see M&A activity start to shrink, start to come down, and I also think the housing market, which was red hot, you came in. I think the 30-year mortgage on January 1st of 2022 was in the kind of the 3.5% range.
Yep.
Now it's almost at 7. I think 6.8.
And the obvious answer is the math is totally different on it at a 6.8% 30-year mortgage.
To put it in perspective, if you were the person going to buy a $392,000 house, right now in October of 2022, that monthly payment, if you went back a year, that monthly payment would have bought you a $600,000 house. It just goes to show you the how far interest rates have come up. And in your portfolios, where you see that is obviously on the bond side, where you traditionally in these markets where equities are off, 20, 25%, which we know that equities are going to do from time to time. That's how we get to earn, that equity risk premium that we've talked about in previous videos. But bonds are now off, 14, 15, 16%. And that's high quality U.S. treasuries and agencies. The safest bonds on the planet are down mid double digits. And I think that is where you are really starting to see the effects of this interest rate policy in your portfolios, and people felt it in their portfolios before it got to the real economy, right? It's not like the 30-year mortgage went to 7%, almost to 7% overnight. But in the bond market, those interest rates happened really quickly. And it took a lot of people by surprise.
So, and maybe our final discussion point, let's start talking going forward. And I think no one's happy right now. We as advisors, we as a wealth management firm, you as clients, look, no one's happy with bonds off 14, 15, US large cap off, 24, 25, Russell 2000, international EM, to your point earlier, there really hadn't been anywhere to hide except for cash. But what do we think going forward?
Well, I think going forward, first, we opened this up, we said this time, the most infamous words in finance are this time is different. I also think like almost an equally damaging or dangerous phrase is we've never been here before. This is uncharted territory. Well, it's always true in the moment, but markets are always evolving. So it's true, right? The dot-com bubble was new and novel. The internet was like a thing for 10 years, and we saw stocks go like this, and then we saw them go like that. Internet hadn't been around all that long. It was very new and novel. The great financial crisis, we've never seen real estate have volatility like that on the private side, residential, commercial, until it happened. Right. And I think that this idea of we've never been here before can lead to some really bad decisions. And I think when we look forward, that becomes just as dangerous a phrase of this time is different, because from where we stand right now, and I want to echo Dave's sentiments, nobody's happy. We're all trying to see where we could have been better. Some of the things that we did in the portfolio that have worked, could we have done more? But looking forward, lower prices are the building blocks for higher prices and better expected rates of return.
Higher future prices, lower current prices. Yes.
Right. And so it's this idea of, we finally get to buy low. I've talked off and on about valuations of stocks and bonds for the last 3 or 4 years, lamenting the fact that zero interest rates have kind of made everything expensive. Well, now we're at a point where bond yields are attractive for the first time in over a decade.
Savers are finally getting rewarded. Probably, yeah. You go back to 08, 09 when we cut to the bone. We really haven't been rewarded. Exactly right.
You're able to get, and you're able to get really attractive yields. Bonds are starting to attract capital because you can earn, 3.5%, 4% tax-free in a muni, or over 5% taxable in a corporate bond.
Yep.
Those are attractive. And then you look at the valuations that we have in the U.S. We'll just take domestic small caps. The Russell 2000, it's trading at the cheapest forward valuations we've had since 1990. We're talking about almost 30 years.
Right.
That's where we are. Mid cap stocks are trading where they, from a valuation perspective, are where they were in 2008, 2009. I wish we could avoid having to get to the pain to get to where valuations are right now. But if you're willing to take a longer term time horizon, and even on the medium term, capital put to work in these asset classes where valuations are very good, they're building blocks for better expected rates of return in the future, higher prices, we're finally able to buy low. And I think that is, if there's anything encouraging, and by no means are we saying that the volatility that we're seeing in capital markets is over, but you're starting to see some valuations where entry points, adding additional incremental capital, look attractive. And it's been a while since we've been able to say that.
Well, and in the letter you touch on, there is no other option, right? Basically the mantra for the last 2 years was, hey, bonds are paying you 1%, you might as well go into equities. There are options starting to emerge with financing no longer being zero.
Right, and I think that, the TINA, or there is no alternative to owning stocks, was something that was really dominated for the last post-great financial crisis, because rates have been anchored near zero for, a decade plus. And now you're finding that bonds are, have attractive yields to it. And we had always said that we were never going to abandon bonds. I compared it to abandoning your wingman. A Top Gun reference. Every other letter, not in this one, but probably in the next one. Just recently watched Maverick. I'm a fan. But I think what you're seeing is that if you had kept a diversified portfolio, okay, well, bonds look more attractive now. That's a better source of returns. And for folks like us that never abandoned fixed income, we might have, lowered our interest rate sensitivity, added some real assets that have really helped us. But now you're looking at it, and that's going to be that is another alternative to your portfolio. And bonds are a seesaw, right? As prices go down, yields go up. And for the longest time, for the last 10 years, to earn rates of return in bonds, you were really focused on yields consistently going down and prices going up. Well, now it's the other way, where you can earn reasonably good yields.
Yep.
And if the forward curves on the interest rates are to be believed, well, we do expect interest rates to roll over time. That's going to also create a little bit of a pricing mechanism that can be in your favor as well. Holding a diversified portfolio, we can't make it feel good, especially when bonds are down double digits. But compared to stocks, bonds have still done comparatively better. And I think that does give you a base, but you're reinvesting those coupons as bonds come due, whether in a mutual fund or in individual municipal bonds. You get to reinvest at a higher rate. That higher yield is going to lead to a better return than, say, a bond you bought 5 years ago, 6 years ago.
And what I've been talking about with clients as well is, the questions coming up, hey, when do you guys lean in? Traditional equities are off. Pick what market, you're off anywhere from 20 to 30%. And my answer typically is, look, these are wonderful buying opportunities. We just probably won't know it for 2 to 3 years into the future. I think maybe let's close on leaning in, right? Because we're getting a lot of these questions, right? Yeah. We're not smart enough to call the bottom. No one is, in my opinion. But how do you react in a bear market environment?
I think that if you're an investor that has a longer term time horizon, you can start to take individual bites. I think Bank of America had it the best, where they said you kind of nibble at 3,600 on the S&P and you gorge at 3,000. Right? I don't know that we're going to get down to 3,000, but I think I tend to agree with that sentiment where, stocks are on sale. Could they get cheaper? They sure could, and they very well might.
They might.
But I think if you start to take a reasonable approach, where if you have a longer term time horizon, you can start to buy low. And if you buy low, we're never going to call the bottom. It'll probably go down before it goes back up. And to your point, in 18, 24, 36 months, you look at when you bought and you look at those future expected rates of return, both on bonds and stocks, I think you feel very good about where you are and where you're going to be.
Yep.
And I think that's where it's this balanced approach, because you can't just shove all your chips in. Like, there hasn't been this big market capitulation where, even back in 2009, I remember, the S&P 500 was down 62%. There were still people that said, well, it could go down further. And it ended up being a generational buying opportunity. Yep. To your point, you're never going to know. But if we accept the fact that lower prices are the building blocks for expected future rates of return, better expected rates of return, I certainly think that you can start to selectively add exposure here.
So maybe let's close, but this time isn't different. I think what we've learned again is capital market cycles are still there. People still get too enthusiastic when things are great, i.e. large cap growth. Things get bid up. And now, you look at the world, and we didn't even touch on Russia, Ukraine, or Taiwan and China and geopolitical concerns. But I think for our clients, the message is, look, we're in this with you. We would welcome a chance to have a conversation with you, or we'll be reaching out to you to, with quarterly meetings and kind of talking through this. But the sun will rise, and things will rebound inevitably.
Yeah, I think the big takeaway, obviously, from the last 24 months is that capitalism still is the best form of an economic cycle, and not everybody can be a winner. You can't. Not everybody can win. An economy doesn't function that way. I think we're getting through that reset. Yep. And then hopefully, we get to a point where, in 2 or 3 years, we look back and say that was very difficult, but we got through it together. Our relationship as advisors and clients got stronger, and that bond is what really makes going through these difficult times a little bit easier.
Absolutely.
Easier to stomach. And I think, like you said, the sun will rise. Markets typically grind higher, but it doesn't happen overnight. And I think that our clients should know that. We don't expect them to happen overnight, but we're here to be with you and help make sure that as markets do grind higher, your portfolio is where it needs to be to achieve your goals and objectives. And like Dave said, we welcome the opportunity to talk to you in the coming weeks and months ahead.